What's up, everybody? It's your boy Orlando, aka King Smitty, and welcome back to my trading journey. Nice to see y'all back again. For those who haven't joined in before, welcome to my channel. Before we get started, go ahead and hit that like and subscribe button. We're trying to make our way to 100 subscribers, and in this video, I want to talk about FOMO. Before we get into that, let's look at my portfolio year to date. You can see I am up 82.63% year to date in this portfolio compared to the S&P 500, which is only up 15.4%. And that's good as well for the S&P 500. That has an annual return of roughly, let's say, 9%. So it's above its annual projections, and we're above what it is year to date. Right? So today I want to talk about FOMO, the fear of missing out. And I have a article I'm gonna post on the side. We'll put it on this side, that side, and let's see what it says. It says FOMO, or the fear of missing out, when trading applies to the anxiety of potentially passing up a profitable investment that an investor may experience. For investors who visualize a scenario where a stock rises sharply in value but goes unpurchased, the fear of missing out may cause them to make investing decisions that aren't fully thought out or thought through or in line with their investing strategy. Right? And then it goes on and says, what is FOMO trading? FOMO trading happens when an investor allows their fear of missing out to drive their investing decisions. So, the fear of missing out, when a stock runs up, say for instance, the stock was at $10 and it ran up to like $40. And now you're like, hey man, this stock is blowing up and it's going to be big in the future. And so then you buy in right now at $40. Next thing you know, the stock is dropping to like 25 because one, stocks doesn't go straight up. It doesn't move in a straight line. They're normally like a little stagnant or like a little staggering, shall I say. So it goes up and it's going to come back down. And if it's a truly good stock, it will go back up. And in the long run, $40 might be low. It might blow up to like $400, $500 one day. But in the short term, it's very well possible that that stock does pull back. And now you're losing money on this great stock. Right? In situations like that, the people who bought in at $10 and lower, even $15, if it's at $40 now, they're not going to just leave their money in there all the time. They're going to start taking profits. And once they start taking profits, it's going to cause the stock to go down because a lot of selling. As well as if it runs up too fast, people are going to start shorting it because they know people are going to start taking profit, which is also going to like kind of push the chart down a little bit. And if you buying it at 40 and they're getting out and now the stock is being shorted back down a little bit, at that point you're holding the bag. Holding the bag is when you kind of bought in late. You could have bought it on time, and now once everybody's leaving, you're just holding it, losing money holding it. So I mean, we're trying not to be bag holders. We're trying to make money. We're trying to get a sound investing plan. Right? So let's look at this. It says ways to avoid FOMO trading. Of course, like we just read, FOMO is the fear of missing out. Invest with a plan in mind. Investors who trade according to a well thought out plan or investing strategy and not with a FOMO mindset. If you have a plan, stick to the plan. Not saying your plan is perfect, but that can avoid you from buying a hyped up stock at a hyped up moment. There's thousands and thousands of stocks in the stock market that you can buy. So if this one runs up, I'm sure there's other sympathy plays in that same sector that hasn't ran up as much yet. There's stocks in other sectors that are just waiting for their bubble to start being blown up. There's more things you can invest in rather than that one stock. It goes on and says to stay calm in a high volatile market. Many impulse trades come at a time when markets move fast. So now you see this market moving, that stock moving really fast. You're like, man, I'm gonna miss the boat. I gotta get on this thing. And you take that impulsive decision, you buy at the high, and now next thing you know, it's falling back down. You're like, dang, this was the hottest stock around. How am I the only one losing money? Because you made an impulsive decision. You didn't stick to your trading plan. Your trading plan might be, hey, I'm gonna buy this stock at $8 once it pulls back, but then it runs. You're like, dang, I really want to get into this stock, but I want to do it before it hits $100 and it's at 40 now. Let me buy. You steered away from your plan. You made an impulse decision. You're bag holding now, right? If the stock runs up like that, just take a second, look at the stock, and reevaluate it. Reevaluate it, right? Next, be sensible about trading. A single stock market trade rarely makes or breaks an investment portfolio. If one stock can make or break your portfolio, you are not diversified enough. And I hope that is not in your trading plan. Of course, I'm not a financial advisor, but one trade should not. It's not. We're not trying to gamble out here. We're not trying to lose the house or nothing. One stock should not be able to make or break you. Don't put all your eggs in one basket. Avoid investing money if you can't afford to lose. Never play with money you can't afford to lose. All the time I have people ask me, hey, well, how much money do I need to start with investing? And I tell them, I'm not a financial advisor. I don't know your financial situation or your financial lifestyle. I don't know what your bills are, how much money you have after everything is paid and after you have food in the house. I don't know that. So I always tell them, I mean, it really varies and it varies person to person. Once I say that, I don't get a lot of answers back, no response back to my IMs, but it really varies person to person. Like, some people might have $1,000 to play with every paycheck. Other people might only have 30, and you can work either or. As long as you have a plan and you stick to it, you're gonna make that money grow. But you can't have that fear of missing out either. You shouldn't be investing money that you need to pay for your bills, because in reality you could lose that. And now you lost that money, and now your bills aren't paid. So only money that you can afford to lose. I have a video that I'm gonna try to link at the end for my not my trading journey, but just a little introduction to stocks class that I did earlier a couple years ago. And you just give you a better idea of like how much and where to start at with trading. The next one is don't mistake social media advice for sound investment strategies. Social media, Facebook, Twitter, Instagram, YouTube, Reddit. None of that should be your final research category for stocks. You should always be researching and doing your own due diligence. I can go out right now and say, hey, we're all buying, I don't know, Planet 13, right? One of the stocks I do hold. And that stock could be down big time. And it could be down for a little minute, because for me, that's a long-term hold. But for you, you just heard somebody that you see is good in stocks say, hey, we're buying Planet 13, so I'm going to buy it. But you might not be willing to hold that stock, let's say 5 years, 7 years for that large payout. And you're kind of wanting something that's like in the next 7 months. You feel me? Or you could just invest in that company and not really know what that company does. So you really don't want to have social media as your main source of research. You want to look up these companies, look up their earning reports, their the news they have surrounding them. Look up at the technical analysis with these stocks. You feel me? But let's look at this stock right here. that has been running up recently that I've been a few questions about, and this Nvidia, ticker symbol NVDA. And first, we're gonna look at this monthly chart, and you can see my position. I only got 2 shares of this one, and this isn't my main portfolio. I bought this over a year ago. I'm at $153. That's my average share cost. But you can see it ran up all the way to 437. Well, it's at 426 right now. Well, 427, basically. And somebody wrote me, they're like, hey, is it time to buy Nvidia? Should I buy Nvidia right now? And in my mind, I'm like, first, I know you haven't been watching my YouTube channel. Busted. But no, for real though, I'm like, I'm not a financial advisor, so I can't tell you yes to buy it, no not to buy it. But I can let you know that the fear of missing out is real. This stock has been running up, almost in a straight line in a sense. Now for me, I am waiting for a pullback, right? And this is the monthly chart, and you can see these levels of resistance. Around 108 is the bottom. What is this other one? Around that second blue line, I believe, is around 329. And then that first blue line at the top is at 387. But that's the monthly chart. So now that we have a big look at the actual how that stock moves month to month, let's move to the daily chart for that. Here it looks a little bit different because you can see end of May, early June, there's a gap. And like I like to say, it's not a law, but it is a kind of a rule that all gaps fill. And I'm not saying it's going to fill soon, or it could fill a year or so from now, but you can see that gap from roughly 387 to roughly about $400 looks like. And it's still been moving up. So that gap could fill, but I want you to scroll in, zoom in just a little bit, and the last 2 ticker symbols to the far right, you can see it's like a little doji. So it's like the wick, and it's just a line. The sellers could not win that day, and the buyers could not win that day. It's kind of like almost a reversal pattern. But the next day, it was a red day. It opened up higher than what it was, but it still came down. Not saying that it's a potential reversal. You can see on the RSI though, it is overbought. So it's above 70. Average, you don't want to see it around like 50, 45 range. So it is a possibility that it does pull back. You can see on the MACD that yellow line is starting to get a little bit closer to that green line. So if it does cross, that will be like a downward signal as well. So at this point, for me, my portfolio, I'm probably going to maybe put a stop loss on Nvidia. I'm not sure, depending on how these markets go these next couple of days or weeks. I might put a stop loss on there if I do see it starting to try to fill that gap. And then once it hits that gap, I'll reassess about maybe putting a buy-in for 387. And if it falls below that, then another one at 329. Me. And so that's what I have on the fear of missing out in Nvidia. Nvidia is definitely a very good play. It's been good to me. I'm up in Nvidia. Let's see. I just showed you all my position and where I'm at. So I got in at what it says. I got in at 153. I'm up 178% in Nvidia. So the stock's been really good to me. Like I said, it's not my main portfolio. Let me know how you feel about FOMO, and let me know in the comments if you've ever been a victim of FOMO. If you didn't know what FOMO means before today, now you know. And FOMO doesn't only mean It doesn't only pertain to stocks. It could pertain to any type of situation in your life. Because FOMO is like an anxiety thing. A lot of people get hit with anxiety attacks. Don't let the anxiety take the emotion out of trading, out of investing. This is an emotional state. You trade with your emotions, people are going to take advantage of you. You let your emotions say, hey, this stock is running, I'm going to buy now. You buy now, and the smart investors, they're taking money. So you put money in, we'll take it out. Thank you. Now you holding the back, and now you don't lost 15%, 40% on your money. And now you waiting for it to run back up, trying to average down because you still believe in the stock. But another good thing to kind of look up is just averaging down, or even averaging up in this case. Try to find the best time to average up. You don't want to average up at the highest of all time. You want to wait till it pulls back down and then average up gracefully. But that's what I have, everybody. Thank y'all for rocking with me. It's your boy Orlando, aka King Smitty. Appreciate y'all. You're